Hello, everyone. Thank you for joining our webinar today to cover the benefits to corporate buyers of a 45Z tax credit purchase. Before we get started, just a couple housekeeping items before we introduce our great panel who are so willingly joined us today. We will have a Q&A for this webinar, so please, as we go through the discussion, feel free to provide any questions that you have into the Q&A. And if we have time at the end of the session, we'll answer some of those if we can get to it. The webinar will be recorded and available. It's available on the Mickelson website, and we'll make it available to all of our panelists who can share it with you as well. So we're ready to kick this off, and I'd like to start by introducing our great group of panelists that we have today. My name is Faith Larson. I lead the renewable energy practice for Mickelson and Company. At Mickelson and Company, we really do focus on transferability and transferable credits. So we represent all of the renewable energy asset classes in space, and we also have a practice focused on the railroad industry, where we work on credits both at a federal and state level. So first, I'm going to introduce now our great panelist, Dana Jackson. Dana is a tax partner at RSM. She's been with the firm for 19 years, and she leads RSM's clean energy incentives practice. Dana represents much of the biofuels industry and is an expert in 45Z, so we're excited to have her. Dana is joined by her colleague, Elisabeth Shellen. Elisabeth is a member of RSM's Washington National Tax, Excise, and Energy practice. Elisabeth has over 17 years of both government and private sector experience, and she really advises on tax consulting and also controversy work with the Internal Revenue Service. So we thank both of our RSM colleagues here for joining us. And finally, I'd like to introduce Anthony Reed. Anthony is a partner at FGS Global and advises a diverse portfolio of clients in public affairs matters across food, agriculture, energy, and the sustainability policy landscape. Before being a partner at FGS, Anthony was with ADM for 14 years. He served at the US EPA, and he also spent 11 years on Capitol Hill, mostly with former Speaker Dennis Hastert. So thank you all panelists for participating today. Before I really kick off the discussion here and turn it over to our experts, just a very brief high-level overview for you of the Section 45Z production tax credit, and then we're going to get into a lot of nuances. And the focus here again is, how do we mitigate risk with this credit and also maximize value through structuring for the 45Z production tax credit? So this is a credit that is for clean transportation fuel. And in our webinar, we're going to refer to a lot of this as the biofuels. And what are the biofuels? This is a credit for ethanol, renewable natural gas, biodiesel, and renewable diesel, SAF. And so we're going to focus on looking at how that credit is validated. And so that credit is a production credit that is produced for every gallon of biofuel produced. You generate the credit when you meet certain requirements. And so that's the high level, and we'll get into all the detail about structuring for this credit. And we're going to look at this from the perspective of a corporate buyer. So let's kick off the webinar. And what we're going to start here really is focusing on, as a buyer, what should you look at, or what can you receive to really understand the validity of the credit? And if you purchase this transferable credit, what is going to give you assurance that the credit is valid? So let's start here with Dana. Dana, can you talk a little bit about the purpose of a tax credit opinion, really what it is, and what a buyer can expect to receive in that opinion to feel comfortable with the validity of a 45Z credit?
Yeah, of course. Thanks, Faith. So in general, the purpose of a tax opinion is to assess the tax consequences, provide legal support and documentation, provide penalty protection, support transactions by providing assurance, establishing a level of comfort, and providing audit defense. And specifically, a 45Z tax credit opinion should provide both a quantitative and a qualitative analysis of the 45Z credit for clean fuel producers. The opinion will generally be a formal written statement, and it's going to evaluate whether the clean fuel producer is eligible for the 45Z credit by applying the statute and any related guidance to that producer's facts and circumstances. So tax opinions are typically classified by a degree of certainty or confidence that a tax position will be upheld if it's challenged by the IRS. Each level of authority will reflect a different possibility of success and is used for different purposes. So in the case of transferability and monetizing the 45Z tax credit, opinions are generally going to be issued at more likely than not level of authority, and more likely than not typically means that there's a greater than 50% chance that the tax position will be upheld upon a challenge by the IRS. And I do want to note that a tax opinion does not bind the IRS, but rather it is a professional judgment of the advisor, and it's not a guarantee of the outcome of a potential audit. And so as a buyer of these tax credits, when you are looking at a tax credit opinion that's going to substantiate the 45Z credit, what should you expect this opinion to address? So the opinion should address all of the eligibility requirements for the 45Z credit, and it should start by discussing the producer's facts and circumstances. So this would include, but certainly is not limited to, a description of their qualified facility. It should discuss the clean fuel production process, should discuss how that fuel is distributed, or AKA what we refer to as a qualified sale. It should discuss the determination of the emissions rate, look at whether the IRS excise tax registration requirements have been met, and very importantly, the prevailing wage compliance and record keeping. And so then that opinion should apply all of the 45Z requirements to the producer's facts and circumstances, and then end with an analysis section that opines with a certain level of authority on whether or not that producer met the requirements and is in fact eligible for the 45Z credit. And it should also discuss what the amount of credit is for that clean fuel producer.
That's great. Why don't we turn it over to Elisabeth then? Elisabeth, is there any differentiation in a 45Z credit based on the type of biofuel? And if so, is there an impact when we look at that opinion or other diligence to the analysis or risk profile of the credit?
Yeah, I think there's a few things to keep in mind. So the credit on its face is technology neutral, meaning that anything that is a transportation fuel that meets the required emissions percentage should qualify. If you don't have the right type of fuel, feedstock, or pathway, though, you don't really have a way to access the credit. Your fuel, feedstock, and pathway need to be within the GREET model that's designated to use for this credit. So if you're in a situation like ethanol from forest waste, for example, is not within the GREET model, or biodiesel from Canadian soybean oil would not be within the GREET model. So you need to be aware, in that respect, whether you're, actually eligible or not. Another thing is just the credit requirements itself. The credit distinguishes between sustainable aviation fuel and non-sustainable aviation fuel. And for SAF, you are required to have third-party certification of your emission rate, and that needs to be filed with your tax return. Non-SAF producers are not required to have that. They have an eligible safe harbor to substantiate their emissions rate. And then I think each type of fuel is going to have its own sort of technical or legal sort of quirks. So for RNG, we may ask questions about whether the fuel would meet a certain ASTM specification. We may ask questions about whether the fuel will be considered sold in a quote, qualifying sale because of the way the fuel is historically distributed. So it's important to have a good advisor to walk you through all those issues.
Absolutely. Well, maybe turning kind of Anthony to further this point, as we consider these differences that Elisabeth notes, how are these various industries really addressing the nuances? And is there anything else we could expect from regulations in the future that may change some of the things that Elisabeth is referring to for a biofuel type? What is there anything still we're waiting to be determined in future guidance for any of these biofuels?
Yeah, so for sure we are. And we'll get into some of the details around some of these topics later, but we're expecting at least one, maybe two more sets of guidance from Treasury over the next couple of months. It's kind of a moving target, but Treasury is committed to providing some additional guidance on 45Z by the end of the year. It's important to remember that what we got in January was a notice of intent to propose on 45Z guidance. So there's been a lot of questions about, is it, can you rely on it? There have been questions around that. I think the industry's gotten very comfortable with it being a reliable document, things along those lines, but there are a number of questions that are still out there that the industry is waiting on based on the fuel. And some of this plays into the changes that were made in the credit in the Republican reconciliation bill, the One Big Beautiful Bill Act. But I would just draw the distinction between waiting for some answers to clarify 25 tax year and then the OB3 provisions for 26 and beyond. And some of those things are related to, it was already mentioned, what constitutes a qualified sale? Do the ASTM specs that are listed in the notice of intent, are those hard and fast rules? How does that impact ethanol's ability to use it on exported gallons? What are they going to do with the on-farm pieces? And then just the reliability of the credit. I think people are wanting a little bit more certainty around those things for the 25 tax year. So Treasury understands people need to have that to be able to file their claims. And then Treasury also is going to deal with 26 going forward. So things that were changed, like removing the indirect land use change penalty for corn and soybeans, for example, and crop-based feedstocks will certainly have an impact on the values of the credits. The pathways for modeling for renewable natural gas, specifically from animal manure. Again, the on-farm practices, the change in the value to the SAF credit from $1.75 max to $1 starting in 26. And then the provisional emissions rates ability. So can you, as a facility, put a petition forward to get a better score than what the GREET model provides under the thing? So those are some of the things that people are paying attention to, and they're very fuel specific on a lot of these questions.
Yeah, super interesting. Yeah, so more to come for sure. So why don't we, as we kind of move away then what a buyer would expect to receive or should be on the lookout for addressed in the tax opinion, let's talk a bit about just the transferability process and what both a buyer and seller really need to do in order to actually transfer the credit for the buyer's use. So let's start with Elisabeth. What is required for 6418 transferability? Are there specific registrations or filings or any other documentation that needs to be filed with the IRS to effectuate that transfer between a seller and a buyer?
So this is one of those things that's laid out very simply, but can become more complicated. So you are required to pre-file with the IRS. That's your pre-filing registration. That is done online through the IRS's energy credit portal. Don't wait to do this at the last minute. This is a thing that takes like 20, 30, 40 minutes. You just have to do it, but it's not an automatic process. So when you hit submit, it is not going to immediately spit out a registration number you can use. There'll be a bit of a delay. The regulations also require that both the buyer and the seller sort of document what the transfer is in their transfer election statement, and those get filed with each but both the buyer and the seller's tax return. And again, that's just one of those steps. You have to walk through the regulations and make sure you have all your ducks in a row. And you need to make sure that you're filing that with the tax return. You need to make sure that you're filing your election to transfer your credit on an original timely filed return, including extensions, and that's irrevocable. And original means you can't do it on an amended return.
Very helpful. So maybe to follow that, Elisabeth, Dana, I'll turn it over to you. Who can buy a 45Z credit? Are there specific rules or qualifications as to who can purchase these credits, how much they can purchase, and when they can actually utilize the credit that they purchase?
Yeah, so really, it's buyers. The buyers are going to be taxpayers looking to offset their federal income tax liability, reduce estimated tax payments, and or meet certain sustainability initiatives that their company may have. Typically, we see C corporations with significant tax liabilities as the most interested buyers. However, pass-through entities like S corps, partnerships, and LLCs can purchase tax credits, but it should be noted that with pass-through entities, the credit is going to flow through to its shareholders or members, and that credit will be treated as passive to the transferees. So the passive activity limitations are going to apply in that case, and the full, if that transferee does not have enough passive income, the full credit may not be able to be utilized for that current tax year. But that leads to my next comment, which is that buyers will use the 45Z credit to offset their current income tax liability using the general business credit rules, because a 45Z credit follows the general business credit rules. However, if any additional credit remains after they reduce their tax liability subject to those general business credit rules, the credit can be carried forward up to 22 years and carried back for 3 years. And the way that that's looked at in terms of, do I have to carry it back before I carry it forward? That's going to be very dependent on that taxpayer's specific situation, what other general business credits they may have that need to be carried, that they haven't utilized. So each taxpayer would need to go through an analysis to determine, if they would have to carry it back before it was carried forward.
Oh, that's great. Thank you. Well, it does seem, based on, your comments, that really transferability does seem like an efficient and lower cost structure maybe to utilize as part of a tax planning process and a mechanism to lower a corporate buyer's effective tax rate, outside of things that we're all traditionally used to seeing and experiencing, like tax equity, other credits that may require longer term commitments. So really, I'd like to focus now on other big considerations that a buyer should be aware of as they consider the 45Z credit, and a lot of what's happening, which Anthony has a lot of action happening right now, but really some regulatory updates. And so maybe Anthony, will start with you. So these credits, were further affirmed and even extended with OB3. Is this all we need at this point to be comfortable to transact on these credits? Or what else is happening on the Hill right now, knowing that you've probably been as busy as all get out, but what can we expect from future guidance to even give the comfort more market around transacting on 45Zs?
Yeah, so this is kind of the fun part about Treasury versus everything else that the federal government does from like rules and regulations is Treasury has, and I defer to my other experts on the panel here, the ability to put out proposed rules and guidance that you can rely on as a taxpayer to transact absent additional guidance in the future. So even when they put out proposed rules, we're used to things in like EPA and other places where you get a proposed rule and it's not really final until it's final. In Treasury world, it's a much more reliable process because they'll tell you can rely on this until they issue future guidance. So certainly what we have today is enough guidance to transact on it, and there are rules of the road and people are transacting. And so 100%, it's certainly reliable to move forward on. As I mentioned, there are certainly additional things people are seeking additional clarifications on to provide additional certainty around some things, implementation of the OB3 provisions of the bill, but that will only provide us I think, additional certainty around a number of these things. So I personally believe the questions around qualified sale have been way overblown, and I fully expect Treasury, the OB3 bill specifically directed Treasury to address this question, to give people comfort that as long as you sell to an unrelated party, it can be deemed a qualified sale. So that's the number one issue that we've heard from Treasury, that they've been hearing from stakeholders. They understand it's an issue, and I expect them to provide additional certainty around that. But I know taxpayers have been trying to do certain things to just make sure that they're comfortable with that piece. There are some things around the prevailing wage and apprenticeship provisions, I think, that folks would like a certainty around, like whether or not you have to comply with it in every single year, or just the year that you actually claim the credit, which is how most people interpret the provisions. So we're waiting to see that. And then they're going to continue to update the GREET model. So the scores will change. But again, the beautiful thing about how Treasury does this is, if they come out with a new GREET model, which we're expected by the end of the year, the taxpayer can choose whichever one they want to use. So again, you can rely on what's already out there today, but if anything changes in the tax year, you can elect to choose which one is kind of better for your system. So I think it's absolutely reliable right now, but we are going to get updates for 25 to provide some certainty around these things. And then for 26 and going forward, we'll probably see a proposed rule giving people some safe harbors on being able to transact to address new pathways for animal manure RNG. There are people who are looking for new pathways for corn kernel fiber from ethanol, and some other things around hydrogen. And I think those are kind of the biggest ones. There's questions around indirect land use change. I think that'll be 26 going forward, so that will certainly add to the value. So there's certainly a lot more to come, but definitely enough to transact today, in my opinion.
That's great. I mean, so you've addressed lots of nuances around the different, that would impact different biofuels types and these hot topics. Just looking at biodiesel R&D generally, obviously for a whole host of other reasons, right? And just the overall economics, we have seen production really get scaled back. And in some cases, facilities have remained idle this year. Will we expect to see, from your perspective, any other regs coming up or anything else that's going to impact biodiesel and R&D production go forward for 26 and beyond that will help to get those 45Z volumes up for that biofuel type?
Yeah. I fully expect that by the time we get to the end of Q1 in 26, we're going to have a ton more clarity and updates on the 45Z guidance. We're going to have a proposal on 26 going forward on 45Z. And then I think the biggest overhang in the industry right now from an RD biodiesel production is EPA's long-awaited rule on setting volumes under the RFS, what we call the RVOs, for 26 and 27. EPA has proposed this. We've been waiting on a final rule. We're expecting a final rule, EPA says, sometime in Q1. February is kind of when we're expecting that. And that, I think, is really the big thing, that once we have answers to those questions, the market will know what the volumes are that they have to produce behind. They'll know how the credit stacks all work together, whether it's the RIN, the 45Z credit in particular, how it all works together, and then you'll have line of sight on your economics. So I fully expect the plants to have full line of sight on the plan ahead for the next couple of years by the end of Q1, and I think that's really going to turn the plants back on, up the crush capacity, on and on down the line. So I think once we get past this, it's really going to move.
No, that's great. That's great. Elisabeth, with your prior experience at Treasury, can you walk us through, specifically, as Anthony's just talked about this and timing and what we're expecting, but what is it specifically that we'll see next from Treasury in terms of what form of guidance? And then, to Anthony's point, Anthony kind of touched on it, but what really can we rely on once we get additional guidance? How do we rely on what we already have with the statute and those prior notices that were published with what we'll have go forward?
Okay. Can I just detour for a second and talk about process?
Yes.
So during the Biden administration, one of their main focuses, was climate change and implementation of the Inflation Reduction Act. And there was a Deputy Assistant Secretary of Tax Policy at Treasury who his entire job was dealing with IRA and pushing that guidance through. And I think you saw Treasury, over those years, I don't know, like 900 pages of guidance or something was released. Now we are under the Trump administration, and that dedicated focus to these energy issues is not present. So some of Trump's priorities, like the no tax on tips and things with those types of issues, they are getting attention. And so it's not that Treasury won't release anything, it's just that there's not that focus. It's in that huge lump of everything else that also needs to come out of Treasury. And so I do think there's been some frustration that things are not coming out as quickly as people would like. And I just want to provide some context behind that. It is anticipated that there will be a notice of proposed rulemaking. So when the notice of intent to propose rules came out, there was draft, quote, forthcoming proposed regulations. And I think the expectation is that a lot of that will remain unchanged. A lot of what was in that document is not controversial and would likely move going forward. There's also sort of the staking impact of guidance. So, like people can do whatever they want, but politically, it is very hard to make something worse in the future. So usually the direction things go is they become like more taxpayer favorable or they stay the same. So when the NPR comes out, they have options. So typically they won't say anything when it comes to reliance, or they'll say you can rely upon this when it is published or finalized in the Federal Register. Sometimes they will say you can rely upon this as long as you follow these proposed regulations like in full. I think there's a little bit of nuance to this, though. When we talk about reliance, we're usually talking about you're able to rely on something for penalty protection when it comes to an audit or litigation. There's also just sort of like general reliance, which is that when Treasury and the IRS release this guidance, it is announcing their position. So it's not only how they think of the issue, but they're essentially announcing their audit and their litigation position. And it has historically been the practice of the IRS that they will not take a position in audit or on litigation that's contrary to what's already been published. So things like the notice of intent to propose rules would fall under that category. And an NPRM that doesn't have an explicit reliance provision would also fall within that category. I think, like Anthony said, we're also expecting to see an emissions rate table notice. So that would be for 2025, we had notice 2025-11. That was the notice that basically said, go to the GREET model. Typically, you would pair that with release of your NPRM. So what you'll do is you'll release a package, which means that everything is moving together through the clearance process. And typically you like to package those things because you can move them through quicker. If they're not ready with the GREET model for 2026, based on some of the changes that we anticipate they're going to make based on OB3 and the things that they've been lobbied about, they might split that. I think one of the other things we might see is a provisional emissions rate notice. So it might be folded into the notice of proposed rulemaking. They also have a little bit of strategy, though, because I think, or like strategically, they would like to use people to use the general emissions rate table. Practically, they don't want a lot of people applying for the PER process, the provisional emissions rate process. And so if like the NPRM is ready to go, but they don't think the PER process is ready to go, they might pull that out and issue it in its new notice. The other thing they might do strategically is they don't have a lot of experience with the PER process. And so if it comes out of as a notice, it is a lot easier to modify or amend or clarify a notice than it is to do that to an NPRM. So there's a couple moving pieces, and it will be interesting to see what eventually comes out. So typically, when this new stuff will come out, the old stuff will fade away. And they either will explicitly announce, that these prior notices are obsoleted, or it just becomes obvious, with what they've published and the language that they've used, that those things will not be followed on anymore.
Very interesting. So Anthony, I guess turning it over to you, one, whether you have anything to add, but as Elisabeth describes this, and whether it's the proposed rulemaking or some of these other notices, what are you doing on behalf of all of your clients, in that interim period, whether it's proposed or if something's not included and pulled out separately, to Elisabeth's point, what happens during this time?
Yeah, well, I mean, we've been actively busy trying to influence what does come out when it comes out, to make sure that all these the questions that are that we've talked about are answered as quickly as possible. So we've been asking for most of the year since the Trump guys got here. Here are all the things that we still need. Here, we need updated guidance. Here are the questions that we all have. This is what we need to be in there. Some of it was addressed in OB3, so it gives you some statutory certainty, but it still needs to be implemented at the end of the day. There still needs to be guidance around it so that people can know what the rules of the road are. So a couple of things I think that Elisabeth mentioned. I think I couldn't agree more on the PER process. We've seen there is a similar process that's allowed currently under the 45V hydrogen credit. And what we've seen, to my surprise, is DOE being more receptive to pathway petitions under that process, whereas the prior administration was very clear early on that they did not want to deal with like an LCFS type situation where they're getting hundreds of petitions for different pathways so people can get a couple CI points. There seems to be more openness to looking at some of those. I don't know if that will apply to 45Z, but it is just instructive for people to be aware of, at least as how things have gone thus far. From our client's perspective too, there's the other moving piece, not this isn't three-dimensional chess already, but the on-farm practice piece of this is very important from a carbon intensity perspective for a number of these fuels. And USDA, before the Biden administration left, had issued a proposed rulemaking on biofuel feedstocks that we've been waiting for finalization for. So when Elisabeth talks about, are they going to put forward like a package? What we're hearing is I think USDA would like to issue their final rule for that, for that under that rulemaking that would be tied to the 45Z guidance. So whether they point to each other or how that's going to work, but it's a USDA process that is separate from the Treasury process and how that's going to work. But that will certainly have a huge impact. And there's a lot of stakeholders in the 45Z space who care a lot about that piece for a number of the core commodities that are going to be part of that. So it's important to watch that process along with whatever pieces we're going to get. But kind of pulling it all back together, Faith, is we're continuing to talk to Treasury. You got to be talking to Treasury, DOE, and USDA all at the same time, because they all have equities in this. They're all part of the process. And so we're going to see this first piece, in theory, that Treasury puts out, and then whatever is or is not in there, then we're all going to be going back to either make sure that we comment on it if it's something that can be commented on, because if it's a notice or an updated guidance, then that's not generally open for comment, although they've taken comment on it before. we'll all just participate in that process. So we're all trying to make sure as much of it is in the front end as possible, because there's a concern that if you're not in the first batch, that the likelihood of it getting included down the road becomes less. So we're all trying to make sure we're in the front door as much as possible across all these issues.
Can I add something to the comment process? So Anthony is absolutely right. Even if Treasury or the IRS don't request comments, many people will send in comments anyway. People will be lobbying on it. People will, ask for meetings on it. And just to add my little 2 cents, I do think that it's very helpful, even if you're not speaking to the politicals, if you're speaking to professional staff, politicals will check in with their professional staff and say, what are you hearing? What are people complaining about? What are people mad about? So any interaction you have can move the needle.
Absolutely. Well, moving past that, let's say, as we progress, we are transacting in 45Z. We're closing on 45Z transactions. We're going to have these regs. We're going to continue to move forward. To Elisabeth and Dana, let's get to the point where a buyer has purchased a 45Z. The transfer has been effectuated. They've applied the credit, claimed the credit. Now they're at the point in which the buyer's filing their return. What might happen then? Can we talk about a little bit about what happens in an audit, or what happens, during an audit where the IRS will review a 45Z credit? What can a buyer expect there?
Yeah, and so Faith, we're basing this answer off of just previous audit experience and what the rules say, but of course we have not had a 45Z credit audited yet. So maybe, and we might not see those audits for 3 years. But just speaking from, general audit experience and knowing what these rules say for 45Z, if a buyer is reporting a 45Z credit on their return and that return is audited, and the IRS has an issue with the 45Z credit, the buyer needs to be prepared to provide the IRS with any requested information and documentation they have that supports the credit, just like the tax credit opinion we discussed earlier. And Elisabeth did mention on the registration piece, when you have transferability and registering with the IRS is going to be able to link a buyer and a seller in their system, because the seller is going to report on their return that they've sold the credit, and they'll identify the buyer, and the buyer will be identifying the seller in their tax return. But if for some reason the credit is still being challenged and the IRS disallows all or portion of the credit, and the buyer has exhausted all of their avenues for fighting that, however far they choose to take that up through appeals, and to whatever level they end up either settling or it's determined that the credit is disallowed, the buyer is going to be responsible for any underpayment of tax and any related penalties due to the disallowance of the credit. With that being said, I believe that many of the contracts between the buyers and sellers will address this situation with certain indemnification language, with which, Faith, I think maybe you're probably best suited to talk about that, and what we're seeing within those contracts and how those buyers and sellers are what the contractual languages that references that situation. Elisabeth, I don't know if you have anything to add on.
I always
on the
want to
audit
chime
side.
in. I think when you're thinking about risks of audit, like Dana's right, we don't have any practical experience with this, but the drivers of the credit amount are gallons, produced and sold, your CI score, and prevailing wage and apprenticeship requirements. And for your CI score, you either are required to substantiate it, or you can utilize the safe harbor to substantiate it. And for PWA, arguably, maybe not practically, but arguably, it is fixable, meaning that once that determination is made, you can go back and, pay the people the prevailing wage plus interest plus any penalties. So it's fixable. I mean, practically, you might have issues tracking people down, but it's fixable. So I think you need to focus on, with the credits that you're looking at, what really is your risk. Is there something that you're particularly concerned about? Whether is it substantiating what was sold, who it was sold to, trying to drill down and really think about what it is you need to be worried about.
Yeah, absolutely. And that's it's a great segue into, as you both note, how can we structure these credits between the seller and the buyer to try to mitigate that risk, or put the appropriate protections in place, to protect a buyer so that the buyer is willing to pay a reasonable discount to the face of the tax credit, the gross tax credit value, because they feel they have adequate mitigation for any outstanding risk. So those are all excellent points. And, to Dana's earlier comment, what we really focus on is the transaction itself and structuring it. So certainly help to participate in the underwriting, but in doing a lot of these credits, the general principles and premise around structuring and what you can find in terms of protection in a tax credit purchase agreement are similar to the other credits that we've had, 45Z effective starting this year. So we've done a ton of transactional work on investment tax credits and those other credits where certain provisions within the contract become market, or what's expected to be market for a transaction. So in these transactions, we always expect an indemnity to be provided from the seller of the credit to the buyer. So if there's something that happens with the credit, outside of, for any reason that the credit or a portion of the credit is disallowed, other than for a reason caused by the buyer, the seller provides indemnification. And so how do you look at the indemnification? How do you value that? Well, your indemnification is only as good as your actual financial ability to repay the buyer for the purchase price or the tax credit value, plus any type of interest or penalties or those other things that can be imposed by the IRS. And so you look to the financial health, the balance sheet of the seller. Can they cover that indemnity? And so to further that, there's also tax credit insurance policies. And so that insurance policy can be purchased. Typically, that is purchased at the expense of a seller. A buyer becomes an additional named insured on the policy. And that policy includes a covered tax position that respects those qualifications that you note, Elisabeth, to qualify for the credit that we need to substantiate or verify we comply with. So the covered tax position would respect that CI score or the safe harbor, but respects the fact and covers has an insurable position that the CI score is what you say it is for purposes of calculating the credit, respects that prevailing wage has been met, and a myriad of other covered tax positions. And so you always have the ability to request these additional protections on top of an indemnity. Certainly, like any insurance policy, there are always exclusions, so a buyer does need to be mindful of what those exclusions may be in a policy. Some other interesting nuances I would say around the 45Z is oftentimes you may contractually commit in other credits to be obligated to purchase something that may not already even be operational or have a COD date or be placed in service. And so there might be some changes to the tax credit value based on how much that project may have cost. There are also, so maybe what you're buying may change a little bit. We can mitigate that here by the delivery of actual production that has already occurred. And so we may set up structures in which the funding occurs to only fund on production that's existed, where you can see the documentation that that's happened, and set up schedules to fund on these kind of deliverables so that you can validate the data a bit more than maybe transacting to purchase something that's yet to come in the future. You don't get the delivery of the credit, obviously, in those cases, but sometimes you have a contractual obligation. So, there are certain things in investment tax credits that, you have a recapture period as well. That doesn't exist for the production tax credit. There isn't that 5-year kind of compliance period from the time in which an investment tax credit is generated from a property. So lots of things to consider that we would work with a buyer on to help for structuring. And certainly, that's where, seek out your advisors for what makes the most sense in that. And so I think we're coming to a conclusion with this webinar, and we can probably take some Q&A. But before we even do that, kind of one more question to kind of go out to the panel, as we are anticipating this further guidance and thinking about these transactions that are already occurring. In that insurance policy, kind of the key factor that we see is an exclusion for change in law. So can we talk a bit about the fact that we're kind of transacting on what we have today? We're expecting more to come in the future. What is the real risk of a change in law? And can we talk about change in law when it's prospective in nature or at a certain point in time and go forward versus a change in law that may be retroactive? Any comments there?
Yeah, I'm happy to take a first stab at that. So almost routinely, any changes in the law with respect to tax purposes is prospective. When it's retroactive, it's generally to extend credits that have expired. The biodiesel tax credit is a famous one, to extend ones that have previously expired. But it is extraordinarily rare. I can think of maybe 1 or 2 times in my lifetime where they have retroactively applied a change to a tax year, and it was to address loopholes that were being taken advantage of that were never intended maybe for the tax credit. It is almost always done on a prospective basis because people understand business certainty, that people have planned their businesses to transact around it, or they've already transacted around it. So like OB3 is a great example. Almost every effective date in there is January 1st, 2026 and going forward, to avoid that type of issue. And when they do apply it to the current tax year, as we talked about, they generally will offer an option of electability of the previous rules or the change in rules, but very rarely do they pull the rug out from under you, in the middle of the game retroactively, in my experience.
Oh, that's great. That should, that is something that we hear a lot. And I'd say from, our buyer perspective, and as we're out marketing these credits to buyers, I would say, Anthony, that is kind of the larger question from corporate buyers, is just because of this and what's in the media and how we're hearing these things, and from, what they hear from advisors, that does appear to be the biggest risk, even still at this point. So that's really helpful information to know.
Yeah, and I think it's worth noticing. It's worth noting too that there's talk about like another reconciliation bill, like the idea that they're going to reopen the energy tax credits again. Like the whole idea with the extension of 45Z and others was to get the window out to the end of the administration, so they wouldn't have to address this again through legislation. It's not 100% guarantee. There may be pressure to do certain things. But again, I would expect those to be prospective, but the whole idea of them doing the bill this year was not to have to do energy tax again for at least a couple of years.
Very interesting, very helpful. Anything else from our panel, maybe before we conclude? And I think at this point, unless you guys have anything else, we can open it up to Q&A.
Yeah, and Faith, I did go, because you were talking about the transaction and when cash, when the buyer is funding the credit. And so there was a question in the Q&A that I just went ahead and answered, but I can, talk about it quick for the larger group. The question was about payments for the 45Z credits and how they're generally received. And so Faith can talk about that from what we're seeing with the contract between the buyer and the seller. But just from the tax rules perspective, generally the cash must be received no earlier than the beginning of the taxable year in which the credit is claimed, and no later than the filing of the returns of the buyer and the seller, including the extended due date. But, I think you mentioned, Faith, that some of these are being funded quarterly to match up with estimated tax payments, or as the seller may have a good indication of what the credit is that they're generating during that time frame, like that quarter, for example.
Yeah, absolutely. And I think, Dana, that kind of furthers, I think Andrew's second question is just, yeah, what is the general amount of the credits, and how are more buyers going to come in if we have more guidance, or what do people typically purchase? And that really is based on the actual production. And so even between the biofuels, facilities can produce a drastically different size of credits. We sell 45Z credits that are, $1 million up to several $100 million in a tranche, and anything in between. And because it's based on your production, and then also the CI score. And so just naturally, ethanol production and those facilities are producing, whether it's 60 million gallons on an annual basis up to 150 million gallons, it's large scale production that occurs really consistently throughout the year, right? Limited shutdown. There might be a pre-planned shut down at those facilities for some general annual repair and maintenance, but those are larger scale tax credits that are generated. And then, RNG, particularly, let's say if you're at a dairy operation and you're capturing the methane and converting it into renewable natural gas, that has smaller production. And while, to Anthony's point, we wait to see how the CI on manure-based feedstock pans out, those credits in the interim are smaller typically at this point than ethanol. So there is a credit size for every type of credit buyer. And so, a big buyer who has a $2 billion annual tax liability won't be looking to purchase a $10 million credit, because they're going to have to do so much work to really have an impact. So they're looking for $100 million plus type credit transactions, where we have corporate buyers who might pay $3 million on an annual basis. And, to our earlier requirements, a corporate buyer can buy up to 75% of the value of their tax liability for that year. And so, they may say, I'd like to have, $1.5 million tax credit. And so you place the credits where it makes sense and really drives impact to the buyer, because that's how we also make sure we have a reasonable pricing that's delivered back. And so it's really varies by the facility and what your production is, to Andrew's point. But we have seen lots of very sophisticated buyers who really like the structuring and really view the 45Z credit very favorably because of this risk mitigation, and because of the ability to structure and work with one counterparty potentially over a multi-year commitment. So in our 45Z transactions to date, we might have buyers who commit to purchase from one seller, a facility producing a biofuel, and they'll purchase that generation of tax credit for this year and next year and into 27. So you can have multi-year commitments. We can structure options for that purchase. And there's lots of ways to really kind of create efficiencies and reduced cost, but while also delivering, a high value credit to a corporate buyer. I think if we go through the Q&A,
I can take
Anthony gets a qualified
sale
sale question.
Yeah. Yep. Dana and Faith, I think, have seen me on a panel before go off on this topic. So I feel very strongly about this one. The qualified sale, there was some language in the notice of intent to propose that made it unclear if you sold your fuel to a third-party marketer that it would not be considered a qualified sale for purposes of the tax credit. This is the language that is in the statute and in the guidance has been applied to multiple tax credits over time. The IRS has always just wanted you to not have to produce your gallon and pour it down the drain. It's not intended to make sure that it doesn't go to a third-party marketer, et cetera. So I think that will eventually get cleared up here, but that is the uncertainty that's been out there, is if you sell to a third-party marketer, whether it's RNG, biodiesel, renewable diesel, or ethanol, that it might not be considered a qualified sale for purposes of being able to claim the credit. I think it's ridiculous. I think it was something that was a risk that was not needed to be made, but enough people have brought it up as a topic that the IRS, I think, and Treasury feel like that they are going to provide some additional clarity around that. But that's really the intent, is they don't want people producing gallons and actually not doing anything productive with it. And that shouldn't include third-party marketers.
Yeah, and I think too, Anthony and Elizabeth may want to comment here, but I think that the other intent behind that language in that notice was to not have two taxpayers claiming the 45Z credit on the same gallon of fuel. And that's what they were trying to prevent. And as you just mentioned, in our situations with most of our clients, the way that they're selling their fuel, that's not happening. So we would agree with you that we view how the sales are structured in the industry to be qualifying sales, even with that language. Sorry, go ahead, Elizabeth.
The double dip language or the double dip concern was addressed in OB3. So they changed the definition of transportation fuel. So those types of situations aren't allowed.
Well, I think that that's what we have. Oh, let's see here. Oh, are the webcast slides available for download? Yes, you will have a full copy of this webinar. It's recorded and it can be made available on the Mickelson and Company website. And we'll make sure all the panelists have it for distribution as well if you want to reach out to anyone. And, you know, please reach out. And I think we're coming up to time, but any panelists, thank you so much for your expertise and guidance here. I think, you know, what we see on our end is that buyers, as I noted, think the 45Z is highly attractive, possesses all of the attributes that would make for, you know, a credit to really effectively help to manage a tax strategy and lower that effective tax rate. And so I think just answering some of these questions for a brand new tax credit effectively, and what we've been hearing is very helpful to a corporate buyer, and certainly even some of our sellers, right, as we progress. So there are a lot of 45Z credits still in market for the 2025 tax year, and really for all the years through 29, as these facilities, biofuel producers, will be continuing to produce these credits year over year. So please reach out to the folks on the panel. I thank you so much. And unless we have anything else, I think this will conclude our webinar. Okay, great.
Thanks, Faith.
Well, thanks again. Thank you, guys.
Thank you.